Let's see. What candles do we have? We have gold. We have home construction. We have IPO software. We have solar power. Hess. Spotify. And Target. Okay. So I'm gonna assume, guys, that we look at those and we are thinking that we would be entering this position at the close to date. That would be our analysis. So we need to pick something. So why don't we just vote? And by the way, I'm going to give you just 1 minute maybe. So as you look at my screen, pull out another screen and just look at all of the stocks and then just write one time which stock you would like to play. And then I'm just going to calculate, which stock repeats more often. Please do not submit the stock that you've submitted before, right? So let's go for something else. So I'm going to give you 1 minute. Please do this exercise. So go through all of them, look at the charts, and write down the stock that you would like us to follow this semester, at least as the next stock. All right, guys, I'm back. Let's see what we're coming up with. Okay, maybe one more answer, maybe two more answers. Okay. Okay, so it seems that we are leaning towards SunPower. This is the most voted symbol. Okay, let's do SunPower. All right, guys, so for the next week, as a homework, let's analyze SunPower. Let me quickly show you. Okay, so this is where we are. With SunPower, really good move up. So we would think that we have opened the position right here. on this bar. So please do your analysis, long-term, short-term, tactical analysis, what to expect, where the stop loss should be, and then next week we're gonna follow with this trade just for the sake of it, so that we would know. Let's vote on the stop loss, because this is very important as well. Where do you guys think that our stop loss should be? And let me just determine the points here. Okay, 1, 2, 3, maybe 4. If we're extremely conservative. Which level do you think our stop loss should be? Okay, below 11, point number 2, below 11, point number 4. Okay. Michael, I wonder what you think. Where the stop loss should be if we're entering at this point right here. Three, okay. Okay, so 2 under the last low. Okay. All right, sounds good. This is the trade we are in. Please analyze, send me your charts, and we'll discuss it next week. Okay, great. Another segment is done. Awesome. Okay, let's go to a Q&A. We have just one question here from Simon. So Simon is talking about the last week assignment, and he says predicting volume was just price information. In this exercise, where you did use the volume information based on price information, would it be fair to say that the assumption when performing this task is that Wyckoff law of effort and the result is complied to that there is synchronicity between price and volume? Yes. So this is one of the main concepts that we are studying in this class with our analysis of the price and the volume. We're looking either for the synchronicity, or we're looking for some kind of divergence in the price volume behavior. If it's true, then is it reasonable that when you disclose the solution slide that there could be a misalignment where price and volume are not in synchronicity, because price and volume will not always exhibit synchronicity? Yes, so sometimes there would be a divergence. So where this divergence could be found on this particular chart that we looked at last time. Okay, so we would be looking for disharmony or divergences where, let's say, effort is increasing and the result is not following the effort. Okay, so where could we find this? For instance, on this attempt to go down, we have an increase in downward effort to push the price down, and yet the price does not commit below the level of the support, quickly recovers, and the same happens on the next reaction. Increase in effort and decrease in the result. So that's a disharmony. And when we think about what has happened here, the way how we translated the price into the volume signature, because in both cases we said there's going to be an increase in the volume. Well, why do we say this? Because we see the increase in spread to the downside, we see an increase in spread to the upside. So there is a lot of volatility suggesting that both selling and buying, active selling and buying, is happening in this area. The same happens on the next rally. And that suggests that the volume spike is going to be in place at this spots. And right away, we understand that with the increase of both selling and buying, volume will increase, meaning that the effort is going to increase as well, on both sides, by the way, not just to the downside. And by the result, we judge what kind of effort we could possibly have at that spot. There could be some other maybe less evident points of where the same law of effort versus result will play in, right? So for instance, on the upside, we could note that maybe an upthrust like this would have an increased effort, which is local, not necessarily a huge volume spike, but still higher than what we've seen before. And then that does not produce a big result over the previous resistance. Something like this, maybe, not this, like this. This is definitely more climactic, so we would be expecting some volume signature here. So a lot of effort to try to push up and yet does not go higher. Something like this with a more local increase in the volume signature. Something like this where short term we are expecting that there's going to be an increase in the volume signature. So effort goes up and the result is not really that much. It's just a low that touches the trend line. And then at any of the spots where you have like small increases in volume signature, something like this, and then there is stop in action, that would be your effort versus result. Okay, great. The second question was about action and test. So action and test as a concept could be interpreted in so many ways in the Wyckoff methodology. For instance, you could be thinking about action as the price goes up on one bar, and then the next bar is going to be the test of that action. So if we have had the bar where the demand has increased and the price has followed, we are expecting that the test is going to be a continuation of that move, of that momentum. And if that test fails, then there is something wrong with the whole picture, and we would be expecting a reaction here. We could also think about action and test in terms of the swings. We could have a swing as an action and then a reaction as a test. And we would be looking at the characteristics of high lows. This is a structural characteristic of lowering supply signature. This is an effort characteristic. In order for us to make a judgment about the test. So the test here is successful. We have a reversal as a confirmation of that test, and therefore we are expecting a rally. The rally comes as an action, and it just doesn't have the same, the same type of momentum behind, and there is only temporary commitment. So we could think that if this is action, what is the test? Well, the test is such that it shows that there was increased volatility, and yet the test to this flow right here shows a favorable scenario. We also could be thinking about phases in the range, and we would be thinking that phase C, for instance, we could be saying that in phase A, volatility was slightly increasing, but not as much as in phase B. So if phase B is an action on volatility, then phase C is that test. If phase C is an action in terms of volatility and how it unfolded, then phase D could be a test. There could be also some local tests in phase C, right? So action test is a concept that you could apply probably to anything what you could think of when you're comparing one thing over another. You could also think about, let's say, a volume signature that suggests some buying, and then the subsequent decrease of that volume signature on the reaction that follows. One is an action, another one is a test. So there are quite a few ways of how we could use the action and test concept in our analysis. So just use it predominantly with the bar-by-bar analysis, use it predominantly with the swing analysis. I would concentrate on that, but understand that you could definitely use it in so many other ways. All right, great. So we are at 20-5. Excellent. Now let's talk about our theoretical material today. But for those of you who were students in the most recent in-summer series of the WTC, we have not talked about the significant bars in extension. So this is why we're coming to this material. Practicum is becoming also the class where I'm teaching as well. So each class there's going to be some kind of material, either new material or something that we're going to repeat, and maybe there's a new twist that I want to talk about. Today we're going to talk about points of entry and exit, and specifically significant bar concept. Significant bar concept is a confirmation of the swing reversal. We want to understand if phase C ends, that it ends with the reversal. If phase D backing up action ends, we want to find that reversal, and so on and so forth. So let's look at this theoretical representation of where exactly we would be coming into the position and getting out. So let's go through this step by step. In the accumulation, we would be seeking to enter initially in phase C, and then phase D and early E. These are the areas of where we would want to get into the position. It allows us to get into the position at 4 spots. So instantly, when I'm thinking about 4 spots, I'm thinking that, for instance, if I'm in an institution and my total risk is 1% of the portfolio, then I'm probably going to divide that into a probe position, which is going to be 25 basis points. And then position number, so this would be 1. Position number 2, another 25 basis points. And this is going to be my sign of strength rally. Number 3, another 25 basis points. And number 4, another 25 basis points on the backing up action. And the total of that would be that 1% for a total risk. Okay, so where are those points of entry? Well, we want to start probing after what we think is phase C, right? So the price temporarily commits, and before that we could look at the characteristics of how the reaction is going down, and that's why cannabis stocks are somewhat appealing in the way how they came down. And then we want to have a local confirmation where we have some kind of retest of the previous low. And on the reversal of that test, this is where we want to go in. So we want to see some kind of reversal bar with the close committing above the previous bars, above the highs of those bars, and this is going to be our probe position. If it doesn't work, we are only down 25 basis points. Not a big deal. But if we are correct, then we want to increase our size, and the next opportunity for us, once the price breaks out of a local intermediate high, is going to be on the sign of strength bar. Why are those sign of strength bar so favorable for us to enter the position? It's because there is a lot of momentum, and therefore a lot of institutional buying that happens on those bars. And with that, they are pushing the price up, and the close is such that is far away from the low or the open for that bar. So if we move the stop loss towards the low of that bar, it shouldn't be touched. Institutions have bought through this price, and if the price would start going down, they probably would buy more. Because if they are buying like this with 25 basis points or kind of gradually building their positions, they wouldn't mind the price to go down on the idea that they like. So therefore, if the price goes down, they start buying again. That supports the price and pushes the price up. That's how it works on the way up. So we would open second position here, and then we would wait. And the reason why we would wait after we've acquired a second tranche at 1/2 of the trading range is that we're actually going into the area that is not favorable for opening the position unless we have the confirmation of the availability of the supply at the backing up action. So in other words, we need to experience another test at the higher level before we have the conviction to increase our position size. Plus, if we're opening on the way up, we know that the backing up action structurally will expose us, to the weakness, short-term weakness on the reaction. And in a lot of cases, we're going to be nervous. Emotionally, we're not going to be there because the price is going to go down. And some of us are going to close those positions, and definitely we don't want that. So wait for the sign of strength to happen. You're already in these two tranches. And then once the backing up action is being confirmed, and imagine if it's not, then the price goes down and you're down 50 basis points and not your whole risk that you would usually put. But once the backing up action is confirmed, add on the reversal of the backing up action, and then after that, add on the breakout out of that backing up action. We've discussed a lot that breakout entry. It's not favorable, again, for us to open the position on the breakout of a sign of strength rally. Why is that? Well, because sign of strength rally by itself creates an overbought condition. Overbought condition attracts mean reversion traders, and they sell that condition in anticipation that the price will come back to the mean or even to the support level. And also what happens in the overbought condition is institutional types are taking profits. These two groups would produce a temporary change of character of the backing up action that automatically suggests an increase of the supply and also an increase of the reaction. Therefore, our stop loss could be in jeopardy if we're opening the position somewhere here, or especially after the resistance. There are nuances to when we could actually open on the sign of strength breakout. Those are usually going to be situations where volatility has been exhausted going into phase C to such point that we anticipate a quick acceleration. A really good example of this is the movement of the gold lately, since the actually late of last year. Okay, so what's next? How do we actually put the stop losses? So our original probe position will have the stop loss just below this spring. We could be aggressive with our second point of entry because if this is a true sign of strength bar, the price should continue going up and we shouldn't encounter any resistance. But my preference is usually to be conservative when I'm establishing the position, and then to be aggressive when I'm trying to get out of the position. And that is with the stop loss. So I would just still keep the stop loss in the original place, and then when we have a sign of strength, I would probably move it and put it closer to somewhere in the middle of the range, slightly below. I want to allow the backing up action reaction not to take me out of my position, because I want to build the position. Okay, well, once we have this reversal confirmation, we have a couple of choices. We could put the stop loss for that tranche number 3 right below, and let's say that our first 2 tranches could have maybe like a slightly profitable position for us based on the stop loss. That's scenario number 1. The second scenario is just moving all of the stop losses right away. My preference again would be to be more conservative. We don't know how the backing up action is going to develop. Would it have a spring? Maybe a shakeout, maybe a deep LPS in phase D. So all of those possibilities would probably keep my stop loss still somewhere slightly below 1/2 of the trading range. I don't mind that because I'm here for the whole run. I don't want to be shaken out at the beginning of the move. But once we have the breakout out of the backing up action, the backing up trading range, that's when I would be more aggressive with the stop loss and I would move it right below the backup. Why? Well, because the price committed to the upside, and now we're expecting a continuation of the move. And then every time the price creates the high and that high is being violated with the price movement on the upside, that's a timing signal for us to move the stop loss. And we would be thinking of moving the stop loss, how like I've said, 2 support levels away. And it makes a lot of sense that it's 2 support levels away, because in a lot of cases we might have something like this, where we have maybe a reaction that is being followed by subsequent reaction that could take us out, and then the price is going to continue its movement in the previous direction. So what we want to see is we want to give the price and the trend some room to grow and to have the volatility, short-term volatility that especially in the backing up action here where still supply is present. But every time there is a commitment to the upside, that's when we're gonna move the stop loss, and we're gonna move it 2 supports level away. And going into the end of the campaign, our points of exit are going to be the definition of the buying climax, some elements of the climactic action. And sometimes it's really hard, to find those, because sometimes the volume signature is actually not going to be climactic, especially in stocks. So what do we do with that? Well, we need to look at the price action. So in the instances where we see that the price spread is increasing, where there are some gaps happening, we could assume that this momentum indicates the excitement by weak hands, and that leads into the conclusion of the climactic run. If we don't see even that, and what's happening is that demand is diminishing, and therefore we see a slowing of the momentum, that type of kind of buying climax, like a rolling over buying climax, then here we would be relying mostly on trend line analysis, and we would be looking at some overbought condition, or with the slowing of the momentum, sometimes we have the conditions that the price does not reach an overbought condition, so showing that failure. And that's just different type of buying climaxes that we can experience. I'll be talking more in extension in this cycle of the WTC about that. Once I have that material, I'm going to bring this to your attention, guys. And here after the buying climax, let's say that we are getting rid of our first tranche. 25 basis points is gone, and we are thinking, okay, well, we're seeing some elements of the distribution, maybe a high volume signature suggesting that supply is coming in. We got out. Then we're seeing that the next sell-in produces a change of character bar. Usually that bar is going to be a big downspread bar on a high volume signature, and we're still relatively close to the top. So this is actually quite efficient place to get rid of some of your position if you're finishing your campaign. The reason why it's efficient is because you don't have to wait to close out that position throughout the volatility of the whole trading range. If you're really confident about your read on the climactic action and on the subsequent change of character bar, then I would say go for it. But if you're late, then your next possible exit is going to be after the automatic reaction. The tendency and the mistake in the exit is usually such that we are exiting on the way down. And that's the mistake. We are eliminating a lot of the unrealized gains that we sweated out on the way up. We want to wait for the price to rebound. And the price usually would rebound here. Why would it rebound? Think about weekends. What's their sentiment at this flow? What are they thinking? They are thinking that they did not participate in the previous run, so they feel regret. And then automatic reaction gives them a point of value. As an example, imagine minus 10% on the stock or even more that they wanted to play for a long time. So now they see that value, so they're going to come in and they're going to buy this, and that's what's going to produce that rally. So we know that after the first reaction, there's always going to be a rally. So we don't have to, stress about not selling at the same price. The exception to that is going to be your hypodermic formation, where you basically don't have this opportunity. There is a lot of aggression in selling on the way down because there is an urgency to sell. And this urgency to sell is going to be quick selling, very aggressive. And then also from the same family of the distribution, a TP formation. That is not going to have the first initial good rebound. The second one will be better. But in terms of the efficiency of where you exit in the price, it would be still better to exit on the change of character bar or into the selling of the by the contrarian investor into some supply, emergence of the supply. Well, let's imagine that we were accurate and we actually got rid of our 3 tranches, and we're still keeping one just to see, what the bias is going to be. We were somewhat excited on this upthrust rally, and then it just fails. And whenever it fails, this is probably the last point of conviction that you should have, where you're going to say that, okay, I'm done. This pattern has failed. There was an attempt to go up and commit above the resistance as a continuation of the trend, and it didn't happen. It failed, so I'm out. Okay, well, let's quickly look at the example. We've used this in the WTC course for those of you who have taken this previously, not in the last cycle. So look at the original range. This was in 2008, 2009. So right away, think about the market context at the time. The market was going down, yet the price of the stock was almost horizontal, slightly downsloping. We had our points of entry exactly where we've discussed on our schematic. first after the spring on the test, on the sign of strength before the next resistance point, on the reversal of the backing up action, and on the breakout of the backing up action. Our first campaign could have been closed out by the same rules that we've outlined on the schematic that we had on the previous slide. We want to identify climactic action. Okay, well, here is a bar that has, that climactic characteristics. We probably, could even miss this one, and we probably would be thinking that the next bar as a change of character bar, and look at the size of this bar. Compare it to all of the down bars that we have on the way up. Probably this one would be in line, but that's basically it. Everything else is much smaller. So it looks like after the momentum run, this is a change of character bar. So at least a change of character bar gives us a very clear indication of where we could potentially exit the trade if we are done with this time frame. If we are long-term investors, we still would be keeping this. The reaction to the downside, as in today's bias game, was not as pronounced. It did not break the previous level of the support, and suggested that even in phase A, we are thinking that this is the reaccumulation. For the long-term investor, that's a very valuable tool. Again, I don't want you to underlook the change of character characteristics that would suggest a potential bias. And that's how we're looking at that. Okay, well, the next rally that goes up, with the higher high, suggests that this bias is confirmed. The next higher low, confirmed. The next higher high, confirmed. The next higher low, confirmation again, and so on and so forth. Absorption, momentum, and then the last speculation. And as we got rid of our position, the next element of as a reaccumulation element, we will be thinking about finding a phase C, reversal in phase C, sign of strength bar where we could add to the position, reversal of the backing up action, and then breakout of the backing up action. A little bit kind of condensed here with all of the bars, but hopefully you guys could see this, that I'm picking up the reversal bar on the backing up action that is a test to the action point that has a lot of supply. So we needed to have the test to this action. Okay, and then if we're long-term investors, we would be thinking about, again, a very simplistic identification of the climactic action, which was this bar. Why this bar? Well, because any other previous up bars were not that impressive after the momentum bar. So this looks like the end of the move and has this big, quick movement to the upside. So climactic action, that's exit number one. Second exit on the next bar, change of character. When we look at all of the down bars, since where we open the position, let's say somewhere here, this is a definitive change of character. And then after that, we would be selling here after the secondary test rally. And then the last exit is going to be on this bar. So let me just do this. 1, 2, 3, 4. And we are done. Okay, so that's an example. A question here from Dmitry. Why did you not enter on gap significant bar in the reaccumulation? Which one? You have 4 entries in the reaccumulation buy zone. Yes. 1, 2, 3, and 4. This one right here? Oh, I see. Yes. Yeah, this is a good point. It could have been an entry. Yeah, absolutely. The only problem here with the gap is I'm thinking that this is probably some earnings, so we're anticipating some supply coming in after especially a bar like this. So we still want to have more testing, to this action with the supply. So that just more context to the supply emerging. All right, great. Where are we? 503. Okay, let's talk now about significant bar. We want to understand how we could manage the trade and how we could stay with the trend. So therefore, we want to develop trend following tools that will allow us to stay in the trend for the duration of the majority of the trend. I remember when Ed Secorda came to Golden Gate University for one of the classes, and he was talking about trend analysis. He said that his goal is to take between 50 to 80% of the trend. And to be consistent about that. And if you can do that over a long period of time, then you're going to be extremely successful. And you're going to have, a very high profitability if you're repeating this over and over again. So we want to take these portions, something like this, of these trends. And we want to go through the trend and not get out with all of the reactions that the trend has. So we want to find the tool that will keep us in this position, and yet would define also the dominant theme by the institutions. Are they sellers or are they buyers? Because if they're sellers, we're gonna see that in the price action. If they're buyers, we're gonna see that in the price action. So what is a significant bar? Significant bar is a big bar. It's the bar that has an expanding spread. It's also a bar that indicates the direction of the current bias. And we would see this by the location of the close. Usually a bullish close or a bullish significant bar would have a close above 1/2 of the spread. And then a bearish bar, significant bar, would have a close below 1/2 of the spread. Also, the significant bar will have an element of the result not only in the close, but where the close is happening relative to the most recent support and resistance levels. So for instance, we could see here that our initial swing is to the upside. A big significant bar shows the commitment to the upside. We are assuming that there is an uptrend and it only will be reversed in our eyes when this bar is being reversed. So we need to see some kind of close below the low of this bar. So we define the low, and then we're looking for that bar that's going to commit to the downside on the close, and it's right here. And usually the close, the last 30 minutes, is all institutional, where they are rebalancing their portfolios, rebalancing the ETFs, where they're committing, for the positions for the next day. And even though, Gary Follett always says that the close is not as important right now, I probably would disagree with this. By the way, for those of you who are WMD subscribers, Gary is going to be a guest tomorrow on the WMD show. So definitely check him out. He's going to have the first 20 minutes, unless he, has something else. Coming back to the significant bar, here is the commitment that we have below the low of the last commitment to the upside that is significant. And then after that, what we are basically saying here is that there is a reversal, a confirmation that the upswing is done. The last bar that had the significant commitment to the upside has been reversed, and now the swing has changed from up to down. And this means that we could even open the position here. Imagine that we're opening the position here, and we would be thinking, well, where is our stop loss would be? Naturally above the high, that's number one. That's a conservative stop loss. And then secondly, above the high of the commitment bar. Because if there is a commitment to the downside at this point, shouldn't the price never reverse here if we're expecting a downswing? So it shouldn't go through the level which should be defined either by the high of that down spread bar or by the previous close if we have a gap to the downside. So imagine that we have a stop loss here and we've entered the position at the close, kind of like what we've done with the SunPower. So then how would we move the stop loss? And how would we protect the profits that are being accumulated? Well, we want to see some kind of up bar that is going to be a significant bar closing above the commitment level that was defined by the high of the down bar where we entered. And it seems like there is an attempt to do exactly that. Here is this green bar. It's a significant bar. It has a big spread. The close is above 1/2 of the range. But there is one thing missing from this significant bar, and that is the commitment above a significant level. So it's almost like as if the effort is increasing, but the result is decreasing. That's what that bar is showing us. So that is still in line with the downtrend that was identified by the point of entry bar. And then on the next bar, which is significant as well, we see that there is an attempt to commit to the downside. And this is where we know that institutions are continuing to sell, and we should just move the stop loss above that bar and wait for the continuation of the downtrend, which comes next after a short period of a consolidation where the stop loss would not be moved at all. It's until the next commitment to the downside where the close commits below multiple lows that we would be thinking about moving the stop loss. So we would move the stop loss somewhere here. Then next significant bar, stop loss here. Then next significant bar, stop loss here. The next attempt to go, or not attempt, commitment to the downside and significant bar. And here is our commitment level. And then on this bar right here, we see that there was a commitment above the stop loss level. So our trade is going to be this. Point of entry, point of exit. And please note, we are probably taking what? We're probably taking 50% of the move about. And this is a downtrend. Let's see what we can take in the uptrend. And the rules are going to be the same. We're still looking for the bar that has reversed the last significant bar to the downside. We had that condition. Now we're looking at the stop loss. It's either going to be conservatively here under the low or more aggressively under the significant bar itself. And then we're looking for the next commitment on the significant bar. This looks like more semi-significant, but this one is definitely a significant bar. So we would move the stop loss here. Next bar, or a series of bars, we can combine some of the bars together, and we would just move the stop loss like this. next two bars that are committing to the upside. This is an interesting bar because it has a gap. So the true range of this bar will be the difference between the high and the close of the previous bar. And with that, this is a very big significant bar, so we would move the stop loss there. Then there is a series of non-significant bars, and then a huge significant bar that we probably would divide into half, and we would move the stop loss first below the low and then below the 1/2. Next significant bar and next significant bar. And this is the bar where we would get out. This is our exit. So here's our trade. Please note that we bought at about $70. We sold at about $210 times 3, and these are, I believe, monthly. Yes, monthly. So this is 1, 2, 3, 4, about 4 years. So you are making times 3 in about 4 years. This is a somewhat of a good speed to make money. And you can see how the significant bar helps us in two ways. First, it shows us where reversal happens, that's number one. And secondly, it also acts as a trend following tool because it allows us to move the stop loss, and it also allows us to exit. And that's basically the whole idea behind the significant bar. Okay, well, we still have some time, so we have like about 15 minutes. Let's go through the exercise, and I will need a volunteer. And here with this exercise, what we want to do is we want to talk about where we would possibly start thinking about the entry into the stock and how would we use our significant bar definitions, to stay within the trend. Okay, so let's go to Dmitry. Hi, Dmitry. How are you doing?
Hey, can you hear me?
Yes.
Cool.
All right. So this looks like a very long-term campaign. And the original range out of the IPO price has been formed between $15 and about maybe $7. So let's look into this range, and I want you to give us your perspective as to where potentially you would be seeing a good point of entry for us.
I wouldn't be too excited about the first automatic reaction just because it's an IPO and there isn't much data on it yet.
Mm-hmm.
But on the second test in June, July,
Mm-hmm.
I would probably start looking there personally.
Okay.
In terms of a S-bar popping out at me, I'm going to look at I like the one right on August with the volume.
Mm-hmm.
I do see a little supply tail, but it seems to be the biggest spread to the upside
Mm-hmm.
in that current rally. I like the volume, shows some interest.
Mm-hmm. Well, even if we have a supply tail, I mean, look at the close. It didn't really close below 1/2 of the spread, right? So we know that there is a supply present, and it's probably could be related to this action right here. Actually, throughout this whole level, we see that some selling is happening, even on the IPO bar. So there is an expectation that, we are going to have some kind of resistance. It's what happens next, what's interesting, because if we're expecting that supply is going to come, in all of the cases, we go down. Here we're just horizontal. So we are anticipating supply to come, and we want to see what kind of test to the emergence of the supply we're going to have as an action. emergence of the supply. And so we could, when we look at this bar, it could act both as a point of entry and also as a short-term climactic action, and we could anticipate some kind of reaction. So would you be entering right on this bar right here or somewhere else?
If I was buying just stock and not options, I probably would consider an entry there. Now, given what you said, reminding me about the climactic action on the high volume definitely makes me think twice. But if I was to be honest with you, yeah, I probably would consider
Okay,
a probe position.
absolutely. Okay, so now where our stop loss would be.
I would place, this is my personal risk tolerance, I would place 1/2 stop loss at the low of that bar
Mhm,
and the second half stop loss on the bottom of the mid-June, yes, right there.
mhm. Okay, I think this is a good, solid strategy. Next question. When is the next time when you would move the stop loss?
In right at the end of October, I see some demand coming in.
Mhm,
I would have to look closer, but um, I would probably move the second 1/2 stop loss, the bottom stop loss,
mhm.
and make that after that bar and at the end of November, I would move my full stop loss to the first one where it is.
Okay,
So
so
the bottom of the August bar.
okay, so on this bar right here, we would move this stop loss, right? So somewhere here.
Right. Exactly.
Okay, and then on the commitment, this is a commitment to the upside, so the same idea. Once you see the commitment, this is where we could move both of the stop losses, maybe somewhere here below this
Yes.
low. Okay, when is the next time when you would move the stop loss?
The next time I would move the stop loss is um, I would move. I like the bar in 2000 right on the beginning of 2017.
Okay.
I can see that although the price is declining right before that, the supply signature is also declining. There's less volume, and I don't know. I see that, and then a little spike in the demand comes back. I like that personally.
Hmm.
So I would move the stop loss to the top of the previous trading range. Try to find like a good area of support on the top of the trading range there for the full stop loss.
I'm sorry, say again on the at the top of
So
the trading range, right somewhere here?
yes, yes, right there. Yes,
Okay. All right. Well, there is a commitment to the upside. It's not a big significant bar, but it's like a semi-significant bar. So probably would, as long as you're doing this 1/2 and 1/2, I would agree that, one of the stop losses should be slightly below the resistance level here, somewhere here. Maybe the second one should still stay at the same place. Just if we're thinking about the causality, we're thinking about a much longer price acceleration. So, and we're just at the resistance level. So we want to give the room for the price to go outside of the trading range. Okay, this is very interesting bar
yeah,
because it commits to the upside above the resistance. And we know that we are in some kind of sign of strength rally. And it does look climactic with all of the characteristics. Now, this is a very interesting question. So I want you guys to think for a second about this. I'm going to ask this question right now and write it down. Write down the answers. If this is a climactic action, then where is the trading range? right? Because after the climactic action, shouldn't we have the sequence of change of character, which leads to the automatic reaction, phase A, and so on and so forth, and then we go through phases. Where is our trading range for that climactic action? Dmitry, what do you think?
Well, I would say I personally would label it as the boundaries. Like phase A kind of determines the trading range there. So we have the buying climax as the top of the trading range, and then
Like
the
this?
automatic right, and then
This.
the automatic reaction
Yes.
would be bottom of the trade.
Okay, so this is the trading range. Okay, great. Any other ideas, guys? What else do you see?
You also see that line you drew that goes to the highs of mid 2016. That happens to be a support for the automatic reaction that takes place right there in early 2017. So that is another reason why I probably would, and it's one half around one half the spread of that large S bar you have right there.
Yeah. Okay, that's all valid. All of these observations are valid. So the logic here that I'm thinking about is this. We know that definitionally a sign of strength is going to be a commitment above the line of resistance that was created in phases A and B by the highs. Usually a sign of strength rally will have a culminating move at the end of the rally. It's going to look like a climax with the increase in volume signature and increase in price action. So this bar suggests that this is the climax. Then usually we would experience the backing up action as a horizontal range, and then out of this range we are going to have a resumption of the uptrend. Well, let me ask you this as a question, guys. So we have traveled from, what is it, about 8.5 to about $17, $18. So we have made what? We have made about 100, 120%. It's a high momentum stock. It just shows us that there is so much strength. And then we look at the volume signature and we see how institutions are actually getting into this position. So the reaction that we are anticipating might not necessarily be a horizontal reaction or a downsloping reaction. Remember that there is another type of reaction that we could have. We could have a reaction that would have an upsloping structure to that. And then, if we were thinking that this first leg was the momentum leg where institutions are getting into the position, then the second leg of the uptrend usually is going to be associated with a slightly higher volume signature, because at this period of time there's going to be some profit taken. So it's going to become something like this. Supply is going to increase, then demand is going to increase, because with the increase of the supply, what it does is it produces a reaction, and this reaction produces short-term value for institutions, and they buy. So it's almost that through this area we are absorbing supply on the way up. Vertical absorption is happening. So instead of a horizontal range or downsloping reaction, we might have an upsloping reaction like this. And then the phase C is going to be defined by a local volatility. Here it is. So here is our area of absorption, which should have been a reaction like this, but because of the strength, it's just upsloping. Now, would we have the same characteristics that I've described? Yeah, look at this. Supply is coming in on the buying climax and on the change of character. Then supply comes in on the way to the upside, and then in potential phase C. Now it's a little bit counterintuitive to what we have studied in the schematics, because usually it's horizontal. And I don't advise, to label this or to show you guys, to show to anybody that you're labeling this. I still would prefer you to say that this is an uptrend. But as a concept, I want you to understand the process of what is happening. Some of the institutions have bought throughout the IPO trading range. Then on the way up, some of them are profit taking. And usually it's either an upsloping range like this, or it's going to be a horizontal range where they're taking the profits, and that produces a stopping action, at least temporarily. And once we are done, the third leg is going to have characteristics where supply is low. Why supply is low? Well, because they took all of the supply in the IPO trading range, so value buy. Then they took it on the way up. We see a lot of emerging demand signatures. So this is our momentum and trend following buy. Then they took some profits, profit taken, and they observed whatever the supply came was this profit taken. So we have observed the supply 3 times from now in 3 areas. In one area, horizontal area, and in 2 upsloping areas, uptrend areas. So by the time that we go into this speculative phase, supply is so exhausted that there is nothing left. And that's what produces that quick movement. Think about the value of this information, because if we know that the absorption on the momentum happened, and then the absorption with this profit taking phase has happened as well, we could anticipate a very quick move up, much faster than, let's say, first 2 phases, and therefore we should use specific strategies. Those are going to be much shorter strategies, and our stop losses are going to be much more aggressive. All right, well, with that, now let's come back to Dmitry. So what is going on next? We have moved the stop loss on this bar to where?
To right at the low of that bar.
Of that bar. Okay, where is the next bar when we're gonna move the stop loss?
Next bar, I would say, would be right in May, the beginning of May.
Okay, so this bar right here. Okay, so where is the stop loss? Right below it or somewhere else?
I would probably put, it's not a huge bar, so I would probably put the stop loss at 1/2 of the range of the previous significant bar.
Okay, somewhere here. Okay.
Which coincides with the bottom of that trading range.
Okay, next bar, probably this one?
Yeah.
Okay, so stop loss somewhere here, right?
Below of that bar.
Okay, next bar, stop loss somewhere here.
Right, yes.
Okay, next bar, probably this one. Stop loss probably somewhere here or slightly here.
Yes.
Next 2, we could combine this 2. We could move the stop loss maybe somewhere here. Now think about this speculative phase, what I said. Here you want to be more aggressive with the stop loss, because on the speculative run, you want to take as much money as you can and don't give up a lot of the grounds here, right? So we would literally just go like step by step, something like this.
Mhm.
And that would get us out on the change of character bar right here. And that would be a really good trade. Now, if we entered here, another question that I have here, Dmitry, is let's say we're staying in this trend, we're enjoying it, and so on and so forth, but the biggest problem with the winners for advanced traders, and I'm experiencing the same type of problems, is to where accumulate more. So let's identify appropriate places that are efficient places for us where we would add to the position before we exit. So where do you think those are?
I would not add to the position on the next up bar because
Well,
it's
hold on a second. Next up bar, which bar? Give me the timestamp.
so it would be the 2018 bar.
Hold on a second. We are talking about just one cycle here. So this is a point of entry for us.
Oh, okay.
This is an exit. So we are not discussing what happens after the exit. What I would
Oh,
like for us to do is, if we're just opening one position, that's a waste of a trade, wouldn't you say? I mean, if we're just opening one tranche, that doesn't make sense with this type of trade. It just, you have to be a pig here because this is a high flyer. So you want to load up, you just want to load up at the correct places. So when is the next correct place for us to add to the position after the point of entry?
probably no. Right before the November
Yeah,
2000.
late October. Okay,
Yeah,
this bar. Okay, great. Where else could we add to the position? Literally the next step. Think about our theoretical schematic where we were discussing the points of entry.
2017 bar, right in the beginning of 2017.
Okay, 2017, what would this bar be associated with? Is this a stepping stone trading range, phase C?
This would be a. Well, I see a. It would be actually no. You're maybe not because it's right at the resistance from 2016.
Yeah, look at this resistance. We probably would be hesitant to open on this bar because it goes right into the resistance. So we probably still thinking this range right here. I think this is a really good bar. It comes after phase C. And then before the resistance, we probably have a combination of these two bars where we could still add to the position. So I would add here. Look how there is still some room before the resistance cluster. And then we are relatively close to 1/2 of the trading range. And then I would stop. I would not do anything on this bar because how close it is to the resistance and it's just touching. So you would anticipate that some kind of supply is going to come. There's going to be some kind of stopping action. But the way how the price is behaving here suggests that supply is low and we want to identify that phase C by local volatility. So somewhere here. So probably I would be inclined to think that out of phase C, because of the low volatility, we could enter this position. So somewhere here. All right, so what's the next point where we could add to the position, Dmitry?
I would try to follow that same logic for the next trading range.
Okay.
Look for maybe in an intraday basis or well, this is a weekly, so maybe look at the daily chart. See
Yeah.
if there's a phase C opportunity that I could take a stab at there.
Low
Uh,
volatility trading ranges. So they kind of allow us to go in and establish this position as the price is in phase C or on the way out in phase D. Okay, so where else?
then that bar right right in the middle of May and June. It's a nice S bar,
Uh-huh.
high volume, but not too high, so it doesn't seem like a climactic type of move for me,
Okay,
based on the right
so
there.
out of this area right here, okay. Um, we look where we established our positions, by the way. I don't mind this entry, by the way, but probably after that, I'm gonna stop until a certain point. What is that point? Well, when we look at all of our entries that we've done, we see that they come out of some kind of formation, right? So formation, and those are low volatility. I think this is okay because we're relatively close to the breakout. We're still anticipating momentum to continue, but I would be looking for this type of the reactions, right? So this looks a little bit smaller. I would probably looking for either this, or like a combination of this, maybe like this as one uh, more pronounced, same type of magnitude reaction, right? So we want to make sure that we invest and we add at the same magnitude reaction. That's number one, or quickly right after the breakout. That's why I don't mind this entry, because after the breakout, it happens almost right away. But then after that, we're probably looking at this area right here as our next buy. Oh boy, my Siri is hearing me. Okay, so and that's probably where we're gonna. Sorry, I couldn't quite hear you. Could you please repeat what you said? Oh my goodness. Hold on a second, guys. Sorry about that. Apple technology. Um, so these are probably all of the places where we would go in and add with the reasonable expectation that there's going to be some kind of continuation based on the momentum of the long-term trend. Point of entry number 1, 2, 3, 4, 5, 6, and 7. So we would have a meaningful position going into last speculative run. And this bar definitely gives us that change of character type of feeling because it has all of it. And hopefully, guys, you are exiting just on the idea of the speculation itself. And you are moving those stop losses much faster and more aggressively in the speculative phase, and you're getting out early on at around 45. That would have been a great trade. Now, if you're still holding on to this trade, there are quite a few bullish scenarios right here. We will talk about this, but we're already, way beyond the class time. So with that, we're going to stop here. Dmitry, thank you so much. That was really good.
Thank you.
All right. And guys, as usual, the homework. Let's come back to, we're going to do 2 homeworks. So one is on anatomy of the trade. Please analyze SunPower. The symbol is SPWR. That's assignment number 1. Then you have a bias gain. That's assignment number 2. And then for those of you who have time and you guys want to listen to this recording again and make notes, and you want to send those notes to me, please do so. I always love to look at your notes. And this is a really great exercise. So with that, Really good class, good participation. Thank you for volunteering. As usual, this is the class where, we are trying to go into a lot of details on the analysis. So let's just get into the habit of volunteering and just going through the exercise. Good job, guys, and thank you so much. I'll see you next week. Bye-bye.